There are 11 Incoterms 2020 rules. These globally recognized trade terms, published by the International Chamber of Commerce, determine how costs and risks are split between buyers and sellers conducting international transactions, and when the risk or liability for the goods transfer from the seller to the buyer. I'm Kari Crane, editor of Shipping Solutions International Trade Blog Passages. Today, let's take a closer look at the Incoterms rule CIF, also known as cost, insurance, and freight. But first, make sure you subscribe to this channel so you don't miss any of our Basics of Exporting videos, sharing practical advice for exporters and importers. Here's what you need to know before using the Incoterms CIF. Under CIF, the seller is responsible for loading properly packaged goods on board the vessel they've nominated, the cost of carriage to the named port of destination on the buyer's side, and insurance to that point. CIF is one of only 2 Incoterms 2020 rules that identify which party must purchase insurance. Under CIF, a minimum level of insurance coverage is required, unlike when using CIP. CIF is generally used in shipments of lower value goods. In both cases, the insurance should cover at minimum 110% of the value of the goods, and at least to the point of delivery. The risk or liability for the goods transfers from the seller to the buyer as soon as the goods are loaded on the vessel, before the international carriage takes place. CIF should only be used for sea and inland waterway transport. With all of the C Group terms, the seller is responsible for contracting international transportation. The named place where the transfer of responsibility occurs is always on the buyer's side. Although buyers and less experienced exporters may prefer an F Group term, C Group terms are preferable for experienced exporters. These terms allow you to deal directly with the carrier. Documentation, bills of lading, and all the information needed for letters of credit originate from a single place. C Group terms also give you more negotiation power, especially if you book a lot of freight. CIF is best used in situations where sellers have direct access to the vessel for loading. Think bulk cargo or non-containerized goods. For most exports, carriage paid to might be a better choice. Buyers should consider CIF if they do not have their own cargo insurance. Risk of loss or damage is greater by ocean freight. If the buyer wishes to keep the risk with the seller throughout transport, instead use DAP or DPU. If you are regularly involved in international trade, you need to understand the risks and responsibilities for each of the Incoterms 2020 rules, not just pick the term you always use. Shipping Solutions is here to help. Download our free chart of responsibilities to compare all 11 Incoterms, and our free white paper and introduction to Incoterms. You'll find links below. If you liked this video, like it, share it, and make sure you're subscribed to our channel. Watch for more videos sharing real practical advice for exporters and importers.